everyone for joining RevUP week 8, 7 or 8. Actually, I'll tell me on my next page. Let's see, ready? 8, week 8, financing the sales and just the basics of a mortgage. So I invited Chris Quinn, who is a lender in our office now. He is with Mutual of Omaha. Mutual, how do you say it, Chris? Is it just Mutual of Omaha?
Yeah, Mutual of Omaha Mortgage. There
it is. So anyways, Chris, do you want to start really quick by just introducing yourself a little bit?
Yep. I'm Chris I'm down in the office behind the reception desk down there. Oops. And I started with Mutual of Omaha around June of last year. They've been in the mortgage industry for about 15 years. I've been in the industry since 2005. Yeah, we're a mortgage banker as opposed to a mortgage broker and a bank. So I am licensed. I'm licensed in multiple states, California, Washington, Arizona, Oregon, a bunch of states like that. I can do loans in every state. We do everything from Fannie Mae, Freddie Mac, conventional, to jumbos, to VA, FHA, and yeah, all the loans in between, and have quite a few programs and construction one closes, a bunch of HELOCs, to you name it. We pretty much do it all.
Awesome. Well, thank you for joining. I like having a lender in this class because there's a lot of things that I can talk about, but a lender is more knowledgeable on than me. As I've said before, we've had a few different lenders join us for RevUp and Tech Tuesday, and they're all great. But it's good to have multiple lenders who you can refer for multiple reasons. Sometimes you call a lender and they're going through a family thing or whatever, and you have a new buyer who needs answers now, and you need to get an answer right now. So it's good to have multiple lenders in your phone book who you can talk to. And also, not every lender and every mortgage company can do the same thing, right? Some of them have different products. Some of them work better with first-time home buyers because they have better first-time home buyer products. As I'm going through right now, some lenders do financing on new construction, some do not. Some do financing on vacant land, some do not. So my point in saying that is, if you call a lender and you're only using one lender and that lender can't do a loan, you want to be able to have a backup plan and a backup plan. As Chris knows and Craig Benson knows and other lenders, they know that I have multiple lenders who I'm able to refer, and lenders are cool because they get that they don't need you to be monogamous with them. Just keep that in mind. You'll hear from Chris today. I can vouch for him. He really does amazing work for his clients. And if you ever are in the office and would like to meet him, stop by, knock on his door. He's pretty friendly. He just looks kind of scary. So you wouldn't understand that unless his screen was on. I don't mean that in a bad way. He looks like a Viking. He looks awesome.
That's my new nickname.
I can't get my screen on.
I'll share.
It's the first time I've ever been called a Viking. Appreciate it.
Dude, you totally look like a Viking in a great way. I mean that in a really good way. All right, guys. Well, if this is your first time joining RevUp, well, I guess you would know then. This is a 12-week program. It's kind of start to finish the basics of real estate. And if you haven't seen the previous weeks, don't worry. We're not. They don't necessarily stack on top of each other's, and you have to see the previous weeks to get content from this week. But if you'd like to see any of the previous weeks, reach out to Rachel or Robin. They can share those videos with you. So today we're going to be talking about the basics of financing a sale. And next week, we're about a third of the way, 2/3 of the way through. We're going to talk about the residential listing agreement. So the learning objectives for today is talking about the basic loan types, FHA, VA, and conventional. Talk about some state-sponsored programs available in our area, loan estimates and closing disclosures, and how to estimate your buyer's mortgage and down payments. As always, we start off with an affirmation. Today's affirmation is, I love having counterbalance in my life, and I enjoy the knowledge that hard work in one moment allows me more to play in another. All right, let's jump right in and talk about financing the sale. So as you know, probably there are 3 basic loan types. There's tons of different loans, but the three most common ones in residential sales are FHA, VA, and conventional. There are others like USDA, but today we're going to really focus on these three. So to jump right in, talk about the FHA. FHA is a government backed loan program. There's a maximum loan amount that depends on the county. Chris, do you know what the maximum loan amount is currently for FHA in Pierce County? No worries.
Good question. It just changed. I think it's the cap. I think it's 776. But I'll have to look it up.
And just to clarify, that loan amount is the loan amount, not the purchase amount. So just to clarify, you're putting 3.5% down. He's saying your max loan amount is 776, meaning if you're putting add the 3.5% on top of that. So you can really afford up to, I'm doing quick math, like 805 on the purchase price and still have an FHA loan. One of the attractive parts of an FHA loan is they are only 3.5% down, which is less than most conventional products, which are around 5% on the low. There are variations there. So that's a very attractive portion. Another attractive portion of the FHA loan is you can have the down payment. The down payment can be gifted to you, and Chris, just interrupt me if I say something that's incorrect, because I like to be very upfront and say I'm not a lender and I don't know everything. And so if I say something wrong, please interrupt me. But you can get your down payment as a gift from a family member, whereas with conventional, it's not that simple. There are ways around it, but not always that simple. There's also FHA zero down programs, which is like getting 2 loans for a property, right? So you have a $400,000 home, 400,000 times 0.035, that'd be a $14,000 down payment, which would mean you're financing 386, okay? So if it was a conventional 3.5% down, which isn't really a thing, but if it was, you would have to come up with that 14,000. Well, there are zero down programs that will allow you as a buyer to have a first loan of the 386 and a second loan on the back of the 14,000. And they don't, in most cases, they don't actually make payments on the 14,000. It's just due if they ever sell the property or refinance the property, or once they pay off the 386. Do you want to add anything to that, Chris?
FHA loans predominantly are kind of, there's 3 major reasons you would use one. The limiting factor on them is you do have a front end ratio, as opposed to like a conventional loan. You do not have a front end ratio. You can just have, if you have no debt and your payment is 49% of your debt, you can do that. That's usually 36 to 43 on your front end payment. Housing expense ratio, they call it, on an FHA. Down payment, 3.5%. Can use any kind of, there's a lot of different programs. The one major benefit of FHA is their credit scores go down like a 580. So if you have someone whose credit needs to be fixed, but you don't have time to get their credit fixed, you can go a little bit lower in the credit score. The main reason an FHA loan is, if you have anything above 90%, so if you don't put anything more than 3.5% down, you have mortgage insurance for the life of the loan. There also is an upfront mortgage insurance premium of 1.75%. So it's basically equivalent of buying your rate down, because they do have lower interest rates. I would tell you, usually I explore every option before I go FHA. Main reason being is on conventional, you can do 3% down and your mortgage insurance drops off at 78% automatically, but you don't have that funding fee. And so you could subsequently, but the rates aren't as good as FHA. Where FHA excels is in this market. You make an offer on a property, you're not getting the sellers to pay for closing costs. So on FHA can has a lot larger margins. So if I quote 3.125, it might be offering a rebate of $7,000. So I can't keep that rebate. I give it back to the client, obviously. So now they can use that 7,000 towards closing costs. As opposed to conventional, they don't have as large of margins, and the rates would be substantially higher to get more money for closing costs. So basically, FHA loans are, you have to do a lot of trade-offs. So a lot of ideas and trade-offs. I would say Mutual of Omaha is about $1.1 billion a month in mortgages, and 82 to 85% of that is conventional Fannie Mae, Freddie Mac loans. So that gives you a little bit of an idea. But FHA is definitely has its place big time in the purchase market. It's just, I usually try to explore the other options first and then, go after it that way. But it's not a bad loan at all. It's just, it's definitely, it's niche-y.
Yeah. So the thing with an FHA loan is if you have somebody who cannot qualify for a conventional loan and they want to buy a home, an FHA loan is an amazing product. It's awesome that somebody who has a 580 credit score can buy a home. That's fantastic. And that's why it's good to know that this is an option. But in general, you want to make sure you're working with a lender who can really show your clients that this is not apples to apples. It's all totally different pluses and minuses, and kind of give both scenarios. If you're working with somebody who has that 580 score and really wants to buy a home now, this is the only option for them. So we'll just talk about that. But sometimes there are buyers who, can do a conventional or an FHA loan. And that's where you really want to be working with a lender who will sit down, take the time with them to explain the pluses and minuses. And we're going to talk a little bit more about some of the minuses in just a little bit in regards to the appraisal. So just in case you didn't know what Chris was saying about the front, back, and defined in ratios, what he means by that is you can have 45% debt to income. Oh wait, I'm saying it wrong. Okay, so the simple way that you can know what you'll qualify for on a home as far as payment goes, if you're doing a conventional loan, is you take your income, your gross monthly income, and you multiply it by 0.45. That's 45% of your gross monthly income, and that's your max payment. But then you subtract all your monthly debt payments. FHA goes up to 49%. So you can qualify for a little more, which, as we know in this market, can be a huge difference, especially if somebody has a lot of debt. That extra 4% can actually make a big difference. So that's kind of
Real quick.
Yeah.
Isaac, to correct you on that, I hate to do it.
No, go for it.
You can go up to 56% on FHA. It's case by case. And then on the housing expense ratio, they're usually capping you at 43. But like if you just straight cookie cutter an FHA loan, they're going to want you to be below 40%. But there are case by case, and it is going to be situational, meaning you'd have to have reserves. You'd have to have, some mitigating factors to go above 50, to go to the 56%, but it is possible on FHA. So that is a positive for FHA.
Yeah, and keep interrupting me if I say something wrong. That's why I love having you here, because everything's always changing and I don't have all this in my head. The goal of this meeting, everybody, is to have you learn enough to be dangerous, but not enough to give lending advice. You can explain the basics to your buyers and get them excited about, whoa, I actually can buy a home, and then pass them off to a lender. That's the goal of today. It's not so that you know everything that Chris knows by the end of this meeting. That's not going to happen. So I just want to be clear about that. You don't have to know everything that we're talking about today, but just having a basic overview so you can give kind of a consultation like this to your clients is huge. And frankly, most agents don't take the time to learn this side of the business, and just knowing enough to be dangerous can really help separate you from the competition. All right, let's talk about the VA loan. The VA loan is awesome. It's for people who have served in one of our branches of military. One of the best parts of the VA loan is they no down payment is required. Another amazing part is they have no PMI, private mortgage insurance. That's huge. That's like probably about minimum $200 a month that it saves them, which, as we know, $200 a month is about the equivalent of $40,000 in buying power. So that's huge. do you happen to know, Chris, what the maximum loan amount is currently for VA? Again, totally fine if you don't.
It's a lot. I think 3 million. But
Oh,
like
wow.
talking about loan limits for
VA.
Loan limits for the areas, it's going to be on par with FHA. It's just going to be loan limits per county.
Got it. Okay.
So King, Pierce, Snohomish all have the same loan limit.
Got it. And then what is the ratios on that? The debt to income ratios?
So that's a little bit different. I won't go into too much detail on the VA because it does get a little bit complicated. They do what they call residual income. So they'll actually take into consideration like your cell phone bill, power bill, things like that. So, but they'll be, it's not hard and fast. It just is not. On VA. There's a lot of options. I mean, if you have money, they'll go to 50%. They'll go higher than 50%. If you got, what's that?
It's a little bit case by case.
Yeah, it's case by case, and it's there's no down payment. There is a VA funding fee. So there is if the person does not have any more than 10% disability and it's a first time use, meaning they're 5 years in, they're finally making enough money in the Navy or whatever, and they're making enough money to buy someplace. First time use, 2.3%. So if it's I'm just using simple math so I can do it this way. $500,000 loan, 2.3, their funding fee right off the bat, this is why they don't have mortgage insurance, is going to be $10,000. It's about $13,000.
And now that's not necessarily paid up front. That can be paid in the rear. Am I right?
No, that goes right on top of the loan. So you don't have to come up with any down payment. But if you buy the house for $500,000, now you're going to loan for $513,000.
Okay,
so you can finance the funding fee.
That's what I meant. So the difference is, guys, you're paying zero down, but your loan when you close isn't going to be 500. It's going to be 500 plus that funding fee, which is still awesome. So it's really an incredible.
The rates are ridiculously low.
Ridiculously low. If somebody is a veteran, this is a great thing to educate those people on. The other cool thing that a lot of people don't know is a lot of people think you can only use your VA loan once. That's wrong. You can use it multiple times. You can actually have 2 VA loans at a time. I helped a client last year, bought two homes with his VA loan back to back. All he had to do is stay under that $770,000 or whatever it is total VA loan limit. So he had one home that he bought for around $350, another home that he bought for around $400, and so he was able to qualify for both at the same time because it was under the max loan amount. So the VA loan is really incredible. And then even for people who want to buy more properties and have a VA loan, all you have to do if you have, so let's use my friend who I helped past 2 years buy 2 homes. So now he's maxed out on his VA loans. Yes and no, because all he needs to do is refinance one of them into a conventional loan, and then he can use his VA loan again, right? So there's all kinds of options. And then lastly, he can keep those 2 VA loans and now go with a conventional loan and buy another home. So it's really an amazing card that they have to play that most people don't have. And they obviously deserve it for being veterans. Okay, let's talk about conventional. There are conventional maximum loan amounts are interesting because there's different levels. So there's high val loans, which is don't quote me on this, but between like 500,000 and 776. And then above 776, it's called jumbo loans. Jumbo loans require 10% down. They have higher restriction or requirements regarding reserves. They have slightly higher interest rates and so on. But conventional loan is obviously one of the best products out there because there's so many different things you can do with it. And this is what, as Chris alluded to, the majority of loans are conventional loans. We're going to talk a little bit more about some of the positives versus negatives of having a buyer with a conventional loan as opposed to a buyer with an FHA or VA. Anything you want to add about conventional loans, Chris?
There a lot of times not in this market, but eventually with the down payment assistance, they'll allow up to 6% on some of these down payment assistance. So it's 3%, get you into the home. One of the things that I won't go into too much detail because a lot of this doesn't matter to you guys, is like the mortgage insurance and down payments and all that kind of stuff. Your job is basically, in essence, to just get them in the door so that they can get the financing. The discussions of the intricate details, such as what's the difference between 3% and 5%? Well, that not much when it comes to payment, but it does change the mortgage insurance. So it takes them from 35 to 30%, kind of on the mortgage insurance. But on conventional, there's a reason why 80% of the business that we do is conventional. It's not because they're easier. It's just because it's very simple. It gives the client more financial autonomy. They can get rid of the mortgage insurance. They can buy their rate. They don't have to buy the rate. So there's no funding fee like at VA. There's no upfront mortgage insurance premium. You have options. So it gives me options. So if you got a client, this is something that I tell people right now in this marketplace, it's huge. If you have a client who is buying a $400,000 home in Tacoma, you already know you're right there at the threshold of either possibly finding a property or not. So you got mortgage insurance of $200 a month. That's $50,000. So that's a point. So if you can buy that out for $6,000, now you can buy a house for $450,000. So in essence, you traded that out. Now you don't have mortgage insurance, and now you can buy more home. So there's a lot of flexibility. We can't be as creative as we used to, but this is one way we can be creative on conventional loans, is you can buy out mortgage insurance, and that allows you guys to sell more home and actually get your client into a home, because everybody knows right now 400,000, all these escalations and all these other silly crap that's going on with pricing on homes it's making you have to be flexible, and it's making us have to be flexible so we can even get the loan done.
Thank you. I'm actually going to elaborate a little bit on PMI, but Robin, it shows that you have a question.
Yeah. Do the conventional loans, do they have like a limit that varies from county to county, or is it like statewide or just nationally?
Chris, I'll let you answer.
County, so King, Pierce, and Snohomish County. I think Thurston might be close. You have high balance conforming, and I apologize if I don't have the exact number, but it's like 776, 250. Above that is considered jumbo. Below that, you have until I think it's like 546 or 543. It used to be 510. So it just changed at the beginning of the years to like 536 or 546. So between the 546 and the 776, that's considered high balance conforming. Not much different. It's just the pricing is going to be maybe a little bit higher, not a lot.
And 5%.
The best pricing there is going to be the right around the 450 to 540. That's going to be the sweet spot for obvious reasons. For us, is the bank makes a ton of money on that. They make a lot more money on the higher the loan. It's a lot easier for them to make their money back. So therefore, they make it a little bit more incentivized to get the rates out there really good.
And
but that is county to county. So Spokane has a substantially lower. Same with some counties that you've never even heard of, like in Washington State. They'll have a lot lower limits. So it is county by county, and you can find that on. You just got to type it into Google, just what county has what fees and stuff and what balances.
So that's so I want to jump right back into PMI, because I think PMI is really important. So I'm going to take a pretty far step back and really explain PMI for a second. So PMI is private mortgage insurance. It is required on conventional or FHA loans that have less than a 20% down payment, or you have less than 80% loan to value, or more than 80% loan to value. So because that's a greater risk, right? If somebody has 20% or more equity, then if that person stops paying, the bank only only owes on or only has a lien for 80% of the value of the home. So if they have to foreclose, they're more comfortable, right? Because they have so much more room, right? Or if the market dips and it forecloses, they have 20% of the value in room. So that's why they don't require PMI if you have 20% or greater equity in your property. So that's just something that a lot of people a lot of consumers don't know. They think all their payment is their property taxes and their principal and interest payment, right? Their mortgage payment. Well, there's also PMI, which is a lot of money. So like Chris was talking about, it's about $250 a month, give or take. It totally depends on the loan on the home. So what Chris was saying is with a conventional loan, you can get PMI, you can pay your PMI up front. Okay, so we've talked about this before, but using really basic numbers, if somebody makes $800,000 a month gross before taxes, we're going to take $8,000, multiply it by 0.45, so that's 45%, and that's $3,600. So that's what the monthly payment they qualify for. Well, they also have, $400 a month in student loans and a $600 car payment and $200 a month in credit card debt. So that is, whoops, I messed something up. Now we're at $2,400. Okay, so now the max home they can afford is whatever they can afford for $2,400. Well, that has to include your property taxes, your principal and interest, your homeowner's insurance, which is about $75 to $100 a month, and your PMI. Okay, so that would probably be right now around a $425,000 home. So what Chris was saying is if somebody has a little more money in their pocket and they pay their PMI up front, which would be roughly $6,000, again, totally depends. We're using really basic numbers. So you pay an extra $6,000 on top of your down payment and your closing costs. Well, now you can cut out PMI because you paid for it all up front. And now all that needs to fit in that $2,400 chunk is your principal and interest, your property insurance, and your taxes. And $250 a month is about the equivalent of $50,000 in buying power. So that I just spoke really fast. That's a lot of information. But if there's one thing you take away from this, it's that there are so many different ways that people can qualify for different amounts. So this is why you really want to work with a lender who can be creative and can talk about these different options. Wilson has a question. You're on mute, Wilson.
Okay. Let's say a client's buying a $500,000 home. They plan to put 20% down. So Chris, what if they get there and the appraised value comes above purchase price? I know you might laugh, not these days, but let's say the appraised value comes in higher than purchase price. Can they say, hey, I'd like to hold back a little bit, a little extra cash, or will you guys just go based on purchase price regarding PMI?
Yeah, whatever the lowest, there would be no PMI because they're putting 20% down, but they go off of whatever the lowest is between the appraisal or the purchase price. That's not technically earned equity, so they'll kind of make you earn it by making your payments on the property. So that's kind of a rudimentary way of saying that if they're doing 20% down, they don't have mortgage insurance. But if they're doing, did I answer your question? They wouldn't have mortgage insurance and they would go off the lower of the two values.
Okay, lower of the two values. Gotcha.
Yep.
Vice versa. If the property comes in appraised lower, they're going to go off the appraised value as opposed to the purchase price. And now you're going to have to cover, Isaac and I were talking about this the other day. Now they're going to have to cover, like all these escalations that are happening right now. So you're buying a house for $500,000, or you put the house in the market for $470,000, and you're buying it for $500,000, and the appraisal comes in at $470,000. Well, if you're putting 3% down, you're putting 3% down of the appraised value, not the purchase price. So now you're having to come in with basically, $20,000 plus the 3%, or what, 50, whatever math that it is, $30,000 plus the 3%.
And if you have questions about that, we did a meeting, I think it was 2 Tech Tuesdays ago, about using the additional down payment form, the 2280. And and a calculator on how to explain that to your clients. So we won't spend too much time on that one today because of that, because we just did that. But if you would like to watch that video, email Rachel and she can send that to you. I don't think there's much of a point in talking about this slide too much. It's just saying there's a lot of things that a lender is going to look at. And if you're talking to somebody who has a bad credit score, they've gone through a divorce or a bankruptcy, they have high child support. Child support is essentially considered debt. Judgments, liens, these things can cause hiccups in the lending process. So I'm not saying you should say to somebody who pays $2,000 a month in child support, you can't buy a home. I'm just saying it might be good, like we talked about in Tech Tuesday, to let them know that we have a little bit of a challenge here, and prepare them for when they talk to the lender so they're not blindsided. I think that's really the point of this slide. So we talked about FHA, VA, and conventional and how they're different loans that have different positives and negatives. But when it comes to when I'm representing a seller on a listing and I've got 3 loans, I've got an FHA, I got 3 offers. And let's say they're apples to apples in every way, except for the fact that one's FHA, one's VA, and one's conventional. But they all have the same purchase price and they all have a 3-day inspection period, whatever. There are negatives potentially with an FHA or a VA loan that are less applicable with a conventional loan. A lot of this is not in writing factual, but this is based off of experience. And so what I'm trying to say, there's nothing in the book that says a conventional loan, the appraiser is going to be way easier than an FHA loan. But experience will tell you that is the case. So what I mean by that is an FHA and VA appraiser are generally a little more stringent on value. They're going to be a little more conservative on value. So if they're feeling it's between 520 and 530 as the value, they're probably going to go a little closer to 520 than 530 than a conventional appraiser. Obviously, a lot of this is subjective, but in general, that's the case. FHA and VA are also going to be a little more stringent on condition. So, there's some things that are universal, for example, broken windows, unfinished flooring, major dry rot. Any of the 3 appraisers will call that out. But if there's some flaking paint on the outside of a home and it's a conventional appraiser, they're less likely, again, I'm being careful how I say this because it is somewhat subjective, but they are less likely to call something like that out than a VA or an FHA and appraiser would. So that, again, might just be something helpful to know. So if you're talking to a client and they're like, what the heck, why are we missing out on all these offers? Or they're asking how high above the next offer should they go on the escalation? Just tell them we are starting at a disadvantage with our FHA or VA loan. Not a tremendous disadvantage. It doesn't mean we have to beat all the other offers by 20,000. But as we talked about on Tuesday, when we talked about the escalation clause, if you're an FHA or VA buyer and you're using the escalation clause, you probably want to beat the next highest offer by a lot more than $1,000 because most sellers would rather just roll the dice for a little less money with a conventional buyer than they would with your FHA or VA buyer. We could spend hours talking about this and it would really just be beating a dead horse. But the fact is that's the case. If my offer with my buyer is FHA and Wilson's offer with his buyer is conventional and everything else is the same, 99 out of 100 times the seller is going to encourage, the listing broker is going to encourage the seller to take the conventional offer. And we can argue if that's reasonable, but it really is the case. So, what is the loan estimate? So this is talking about when you first start talking with the lender, the lender should be able to provide a pretty basic worksheet for your client so that they know what they're looking at. So, if you have a client who says they only qualify for a $2,400 a month payment, the lender should be able to provide a pretty good breakdown of what price range that's going to be and how that will look with current interest rates. Just note when you guys are talking to a lender up front, So we're meeting with a buyer today and they say, okay, perfect. We qualify for a $440,000 home with current interest rates and so on. Just know, especially right now, but always, interest rates are fluctuating dramatically. And so it's always important to know, if you barely, as a buyer, qualify for a $440,000 payment and tomorrow interest rates go up by 0.01, you may not qualify for that anymore. That's probably overstating things a little bit, but you get my point. The other thing the lender should be providing upfront, and again, I do this like really before we're even looking at homes, they should talk about what the closing costs are going to be, because that's a huge difference between lenders. And in most of the time, lenders should have a couple options, right? They'll say, okay, we can do this interest rate and your closing cost would be this, or we can do this interest rate and your closing costs would be this, right? It's low, so you can have lower closing costs and higher interest rate, or lower interest rate and higher closing costs. There's a lot of different reasons why that's the case, but in a lot of cases, you can pay a little more out of pocket up front and buy down your interest rate. And so anyways, this is something where you really want to encourage your clients to, and your lender to really talk out these options, because everyone's a little different. Some people want lower payments for 30 years. And that's what they're concerned about. And they've got more money in their pocket because they just got an inheritance or they just sold a home or whatever. So it's really important in your initial buyer's consultation to find out what they're looking to do. How much can you pay out of pocket, and what's the payment you're looking for, and then take that to the lender and have the lender work with those numbers and paint a picture. So the closing disclosure is going to be, so at the end of the purchase and sale, or past the appraisal, the lender is going to send out a closing disclosure. This is going to go out 3 days prior to closing at a minimum, and the closing disclosure is what what escrow will take and then create the final settlement statement. Not too much to talk about here, because it should match up pretty closely to what we talked about when we first started looking at homes, and we talked about the loan estimate like on the last slide. But anyways, this is something important to know, because there are federal regulations that require that the closing disclosure is sent to the buyer within 3 days of closing. So you get the appraisal in, and it's going to take another 3 to 4 business days for the lender to be able to send out the closing disclosure, and then another 3 business days for you to close. So it's important to know that if an appraiser is 3 weeks out, you're probably not going to close for another 30 days. Does that make sense? It's good to know this, because when you are working with first-time home buyers and they don't understand, well, we've been done with the inspection for 3 weeks, what's taking so long? There's a lot of checks and balances, and it takes a lot of time, and they're all governed by, federal regulations. So there's a lot of things like this that you can't speed up. The closing disclosure will also solidify your exact closing costs. Here's your exact down payment, and here's your exact monthly payment. Chris, you want to talk about locking in interest rates? This is a really interesting thing that I think I have a little bit of a gap of knowledge on. But what is the psychology behind locking in an interest rate? Because it's really fascinating to when you have these discussions. Like when do you encourage your buyers to lock in an interest rate? And I know that's a really vague question, so you don't have to go into too much. But can you explain what that means?
Yeah, you have to. So you start the application process. So our pre-approval is a little bit different. On our pre-approval, we say that we want your income documents and things along those lines. Because a lot of times in this marketplace, we're getting a lot of realtors saying, hey, if you check their income, do you know if they're really qualified? And they'll put us to task. So first off, I get a pre-approval out to the client. So now you know what they can qualify for, so you're not spinning your wheels out showing them homes they can't qualify for. Now, the next step is, once you have mutual acceptance, I still don't lock in the rate. The reason I don't lock it in then is because we hedge all of our rates. We pay to lock in that rate. So I'm not a company man so far as I care about every penny that I lose for them or make for them. But we don't want to preemptively lock the rate in then, because now I don't know if you have an inspection. I don't know if you waived inspection. And a deal we're dealing with right now is checking the viability of an HOA. So when you check different things, once all the boxes have been checked and the loan is technically ready to move forward, meaning you've done your inspections, you've done your septic, sewer, all that kind of stuff. Usually at that point, that is when I'll have a bit more of an idea of when we can lock in the rate. When I can lock in the rate is once I have mutual acceptance. So once I have a purchase and sale, PSA signed around, I can technically lock it then, technically. Now, I will let the borrower know, hey, if you're thinking this house isn't going to have a lot of issues, or you don't really care it does have issues, you're going to buy it regardless, I'll lock them in. My philosophy is this. If the rates are where you want them to be at, and you're okay with the rate at that day, go ahead and lock it in. Are they going to move up and down? Yeah, they really are. Sadly, they can go up and down 7 times a day. It's watching that the chart. But I tell you what, if the rate's where you want it to be at, we just go ahead and lock it in. So that's kind of my philosophy in locking. I like to get it locked so that we can basically, because once we lock it, then we can move forward with everything. Now on a purchase, I can still get the loan underwritten without it being locked in. So if someone's just, I don't want to lock the rate in yet, I don't want to lock the rate in yet, and wants to float it, I can float it for quite a while. Now, I don't like to, but I will. So that's kind of the long and short on locking in rates for what I like to do.
So just to kind of elaborate on it a little bit, what we mean by locking in rates is Chris is saying, okay, today your interest rate is 3.2. Tomorrow it could be 3.1. Tomorrow it could be 3.3. I'm using simple round numbers. It's not going to be that simple, but you know what I mean. So it's a gamble. And once you lock, here's the important thing that I don't feel like a lot of buyers realize this. Once you lock your rate, it's locked. So if interest rates go up, you've already committed to 3.2 and you get your 3.2, which is awesome. They go up to 3.5 by the time it closes, you won. You got 3.2 and you're stoked. But if it goes down to 3% by the time it closes, sorry, you're still locked at 3.2. So it's a double-edged sword and it's a gamble either way, which is why I love
Real quickly,
Go ahead.
we do have a thing called a float down. So what happens is, let's say the rate is, let's say I lock you in at 3.25. We're 3 days away from closing. So you just talked about the 3-day closing disclosure going out, right?
Yeah.
At that time, I can do what they call a rate float down. So it's somewhat new. So I don't expect you to know this, Isaac. So what happens is, and it's not every company, what we do at Mutual of Omaha is we do what they call a rate float down. So about 3 days prior to you closing, we check to see where the rates are at today, comparative to 25 days or whatever, 30 days prior. I can float you down if the rate has changed 50 basis points or 1/8 of a point. So in layman's terms, 3.375 is what I lock you in at, and the rate goes down to 3.25. It's going to have had to move 50 basis points, which means that's going to have a pretty decent, and then I can lock you in at 3.25. Now, that's something relatively new. Not every company does that, but it's something that we did to kind of, curtail respectfully the bitching and moaning about rates went way low. What the heck's going on? They went so low. I locked in. I feel like I left a bunch of money on the table. Well, yeah, but the reverse is true as well. What if the rates go up? You're locked in. We pay insurance to get those rates. So that's why we can hedge it at the last 3 days, and then we do a rate float down. Does it happen very often? It's more so me just telling you about it. Does it happen? Out of 100 loans, no. Out of 200 loans, you might get one deal that does it.
That's
so it's
cool.
less than 1%.
I don't know of any other lender doing that. That's pretty sweet. But ultimately, that's why I really appreciate what Chris said earlier, where it's like, are you happy with 3.2? Are we happy with this payment at this purchase price? Lock it. Don't overthink it. Could it go down to 3.1? Sure. Who cares though? Like, don't be greedy, right? So that's really the point of that. I feel like I'm going to sneeze. Okay, it passed. We're good. Whew. Okay. One last thing I want to talk to you guys about. Mortgage calculators are awesome tools. They're not an exact science, but this is something that I again, most people don't realize, they feel like talking to the lender, first off, is very scary. They don't want to talk to the lender. They, you know, they don't want to open their financial closet and show everything and all their financial dirty clothes to the lender. So one thing you can do to, when you're talking to a skittish buyer who's hesitant to talk to a lender, is you can do that simple debt to income math, right? Where we go, where we say, okay, the $8,000 gross monthly income, multiply it by 0.45, again, 45% of 800,000, subtract your debt payments, and now we're at 2,400. And they're like, well, what does that mean? I can afford $2,400 house? No, of course not. You can afford a $2,400 payment. Well, what does that mean? Well, there's a mortgage calculator on your Realty One Group app. It's also on the HomeSnap app and the HomeSpotter app. I'm not going to show it because I wish there was an easy way to just share my screen on my phone, but it's super, super simple to use. You put in a purchase price of 400,000, you put in a down payment of whatever they're expecting, 5%, and then we'll auto calculate taxes based off about 1% of the property value, and roughly, you know, $80 a month or whatever in insurance, and then a rough estimate on PMI. And it will say, okay, perfect. Your payment on a $400,000 home with this interest rate, this PMI, and so on would be this. And we're like, oh, perfect. That's still $400 less than what we were expecting. So we can actually afford, and then you just factor it up. But anyways, I like to use mortgage calculators to show buyers that they can actually afford way more home than they normally think. Most buyers, in my experience, they just assume, well, we make like a combined $90,000 a year, my wife and I, and so we probably don't qualify for much. And then you show them a mortgage calculator and they're like, oh my gosh, we can buy a $500,000 home. So anyways, mortgage calculators, I guess to sum up what I'm saying, are a really amazing way to get somebody from being like, I want to buy a home, to being like, oh my gosh, no, we really can buy a home based off of these numbers. So it's a great tool to use when you're talking to a skittish buyer. So that's all I got, guys. As always, we end Rev Up with the one habit. The one habit is encouraging you to, every day that you commit to working, make 3 phone calls, add 3 people to your database, and send 6 handwritten notes every single day that you work. This is all about doing the tasks that lead to success, because a lot of times you'll go a month where you're not having any clients calling you. And if you keep doing these things, they're working behind the scenes. You just maybe don't see it. So thank you all for joining. Next week, we will be talking
real quickly, Isaac.
Yeah, go for it.
Just two quick things real quickly, for just, if they're writing something down, if they're writing, this is a number down for that mortgage calculator, figure on, if a person's looking at a home and wants to have just a kind of an idea, if they're looking at a $400,000 home and there's one that's 410, figure every $10,000 is $40 in payment on a 30-year loan. So that's where you get to the $400 per 100,000. So if you're kind of talking to someone,
awesome.
Yeah, so if you're talking to someone and they're on the fence of 390, 400,000, just figure on $40 a month. It's actually $3.90, but $40 is easier to remember. So $40 per 10,000, and then you just keep going up from there. And then lastly, on pre-approvals, most loan officers, I can change your pre-approval. So if you send a client that they want to do a 410, I can change pre-approvals on our app in 15 seconds. So you're not bothering a loan officer. You're not bothering me if you guys decided ever to use me and try me out. I have one realtor right now where I changed the pre-approval, sadly, over 45 times. And I don't even think I'm 10 minutes into doing it. So it's just, that's you're not bothering someone by asking that. So if you don't want to do the mortgage calculator, or you want them to talk to someone, it doesn't take a lot of effort. So yeah, that's all I have.
I actually have one more point that you made me think of too. The negative power of debt is really good to know if you're going to ever buy a home, or if you're looking at buying another home. And if you're talking to people who are way out and they're like, yeah, I'm going to be buying in a year or two. What should I know? What should I prepare for? People underestimate the negative effect debt has on them being able to buy a home. So again, going back to our example of somebody making $8,000 a year gross. So you multiply that by, I'm sorry, I'm going to do this just one more time. Multiply that by times 0.45, that's 3,600. Well, that person, if they want to buy a home next year, but then they say, oh, you know what, I'm going to go get a Tesla. That's an $800 a month payment. Okay, so $800 a month, they think it's just $800 a month, I can afford it. That is, going back to Chris's example, $800 a month divided by 50 is 16. So that affects our buying power by $160,000, meaning they would, without that Tesla payment, be able to buy $160,000 more expensive home. That was really simplified math, but hopefully that makes sense. Again, $50. Chris said $40. I was being conservative with my $50, but $50 is the equivalent of $10,000 in purchase power. So that 10,000 times 16 is $160,000. So it's a fine line because you don't want to you don't want to overstep your bounds and tell people, don't buy a Tesla, you should buy a house with me. You don't want to, that's not really your place with most people, but maybe it's your place to educate people on that, right? If someone says, I want to buy a home next year, they say, what should I do? And what should I do? Maybe say, well, let's talk about what you shouldn't do. If you need a car payment, get as small of a car payment as you can for now. Get a bigger car payment after you buy your dream home. So that's a really important thing to remember. I talked to somebody at the end of last year who was just totally gung-ho. He made about $55,000 a year. And I was like, yeah, that should do it. And I was like, what debt do you have? He's like, I've got no debt, no student loans. I was like, man, this is gonna be, he's probably being qualified in the high threes. That should work. Anyway, he just failed to mention that he had just bought his dream car and his payment was literally $900 a month. So he didn't qualify for jack. And it was really sad. He was really, really discouraged. And he also, as you know, when you buy a car brand new, didn't have enough equity to sell the car and change his mind. He's locked in at that car essentially, or he's going to take a big hit. So my point in saying that is not to tell people pick a Tesla over a house because it benefits me. It's really something that a lot of people don't realize, right? And so that's just something that educating your clients can really save them and also help you, obviously, so they could buy a home sooner. So any questions from anyone? I know we covered a lot there. A lot of that was pretty basic, and then we got into depth on some things. So any questions, anybody? All right.
Watch yourself. Don't buy a Tesla.
What? Dude, I want a Tesla.
You and Andrew always talk about buying a Tesla.
God, I want a Tesla so badly. I seriously, it's like.
Oh my gosh, just go buy another iPad. Calm yourself down.
I don't have an iPad. Bridget has an iPad, okay? I don't even have an iPad. Man, they're so cool. I seriously will just spend Mackenzie will come home and the room will be dark. She'll be like, what are you doing? I slam my computer down. I'm like, nothing. She's like, you're looking at Teslas, aren't you? And I'm like, no. Yeah, it's bad. It's bad. I'm obsessed with them.
Another big one, oh my gosh. So I have clients that are getting divorced and it's like they have to go talk to an attorney to decide when is the right time for them to buy a house because of how it's going to impact their finances and credit, because there probably will be child support and what have you. So the approval we once had is not to be in the future.
Yeah, really, really important too. If someone mentions something like divorce or bankruptcy or whatever, just tell them ahead of time. You can probably still buy a home, but we really want to talk to a lender sooner rather than later because that can really change how we're going to go about things. So
oh
that's
my gosh!
What earlier, it's like if someone says these triggers, bankruptcy, divorce, child
marriage,
support, just let people know ahead of time. That's something that we really want to start talking to a lender before you're ready to buy, so that when you are ready to buy, we are ready to buy and we're not just finding out about this stuff. So great point.
Well, and it's also worth your while to make sure that they understand that once they're under contract, that you don't do any of those things either. Don't go out and get a new credit card. Don't go out and buy a car. Don't
furniture. Oh my gosh.
To change your financing.
Yep. Love it. Great, great point. I failed to mention that. That's another really good one, Tad. I always say that as soon as we go mutual, I tell my buyers about wire fraud, and I tell them about do not go buy furniture or anything unless it's cash. And even if it's cash, depending on the type of loan, you might need that cash for your reserves, which is more applicable for jumbo loans. We didn't really talk about it too much, so I'm sorry this meeting's dragging on, but you need a certain amount of money in the bank, cash money in the bank, to qualify for those loans. So even so, just be really cautious. And if you're going to make a big purchase or any purchase that's beyond groceries, talk to your lender and make sure you're not going to blow this loan. So that's a great point. Thanks for saying that, Sarah.
You're welcome. I had it happen before. So
Sad. All right, guys. Thanks again. Everybody have a great day and a wonderful weekend.